Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is Monday, July 13, 2026.
Good to be here. We have quite a lot to get through today.
We really do. Usually when you open up a daily market overview, you expect to see math, like PE ratios, moving averages, maybe some dry commentary on quarterly earnings. It's supposed to be clean, clinical.
Right. You essentially expect a spreadsheet that's just been translated into text.
Exactly. But then you look at today's source material, our daily market briefing, and suddenly it reads less like a financial document and, well, more like the plot of a geopolitical thriller.
Yeah, it really does.
I mean, we are looking at international blockades, sweeping court rulings, and then right next to all that, tens of billions of dollars quietly being poured into the physical foundations of artificial intelligence.
It is a wildly disjointed map of global power and capital today.
It is. So our mission today is to synthesize what has been a deeply complex, very busy day on Wall Street. We want to cut through all this noise to help you understand the major index moves, the shifting economic data, and the absolute most vital geopolitical and corporate headlines that are driving your investments right now.
And there are a lot of them.
But before we jump in, I need to make a quick disclaimer. Today's briefing contains some significant politically charged updates involving former President Trump and the late Senator Lindsey Graham.
Right. Some very heavy political news.
Yeah, so I want to emphasize to you, the listener, that our deep dive today will report strictly on the facts provided in our source material. We are doing this just to assess the market and policy impacts. We aren't taking any political sides or endorsing any viewpoints here.
Absolutely not. We're just looking at how these events actually move the financial needle.
Exactly. Okay, let's unpack this, starting with the macro overview. Because the biggest shockwave today, it isn't coming from Silicon Valley.
No, it's not.
It's coming from the Middle East. Former President Trump has proposed a 20% toll on cargo traveling through the Strait of Hormuz, and this is alongside restarting the Iran blockade.
Which, that fundamentally alters the baseline math for the entire global energy market. It is almost impossible to overstate how significant this specific waterway is to the global economy.
I want to push back on that just a little bit, though.
Yeah.
If you're an everyday investor, sitting in Chicago or London, a toll in the Middle East might feel pretty far away, abstract even.
Sure, I get that.
It feels like we are watching this massive set of dominoes being set up. So how exactly does this first domino, this proposed 20% cargo toll, mechanically knock over the rest of the market?
Well, to understand the mechanism there, you really have to look at the physical geography and, well, the logistics of global shipping.
Okay.
The Strait of Hormuz is essentially the world's most critical oil choke point. It's this narrow waterway connecting the Persian Gulf to the Gulf of Oman, and about a fifth of the world's total global oil consumption, we are talking tens of millions of barrels, passes through that specific strait every single day on these very large crude carriers.
So a 20% toll isn't just a tax on the shipping companies like the Maersks of the world.
No, not at all. It is an immediate, aggressive cost increase on the fundamental energy source of the entire global economy. And, it's not just the toll itself.
What do you mean?
Well, when a major political figure proposes a toll, especially alongside restarting a naval blockade, the marine insurance markets, they react instantly.
Oh, right, the insurance.
Exactly. Lloyd's of London and other major insurers, they immediately hike the war risk premiums for any vessel entering the Persian Gulf. So you had a 20% toll plus these astronomical insurance premiums, and the cost of moving oil skyrockets before a single drop of fuel is even loaded onto the ship.
Wow, and then that cost just cascades down.
Yep, it's passed directly onto the barrel of Brent crude, which is then passed to the refinery, which goes to the gas pump, and finally to the delivery truck, bringing goods to your local grocery store. It is a massive inflationary shockwave.
Which brings us right to the doorstep of the Federal Reserve.
Yeah.
Because the causality here is undeniable. Due to these rising oil prices sparked by the Hormuz developments, the odds of a July rate hike from the Fed are suddenly rising.
And honestly, this is the Fed's ultimate nightmare scenario.
Why nightmare?
Because mechanically speaking, the Federal Reserve only has a hammer, and that hammer is interest rates. They use it to crush demand. If inflation is high because people are buying too much stuff, you raise rates, credit card APRs go up, mortgages get super expensive, people buy less, and prices fall.
Right. Standard monetary policy.
But the Fed cannot print more oil. Jerome Powell cannot lower a cargo toll in the Middle East, and he definitely can't negotiate maritime insurance rates.
So raising rates doesn't actually fix a supply shock. It just, punishes the consumer who is already paying more for gas.
Precisely. A rate hike hurts the domestic consumer, but it doesn't make navigating the Strait of Hormuz any cheaper, so the Fed is completely trapped.
Caught between a rock and a hard place.
Exactly. They're caught between fighting inflation caused by global supply bottlenecks and not wanting to crush the domestic economy with overly high borrowing costs.
And that tension is perfectly captured by Fed Governor Christopher Waller's recent comments from our briefing. He gave this very specific warning that the Fed shouldn't fight the last war on inflation while also acknowledging that hikes are still, on the table.
Waller is signaling something very important to the markets with that phrase. He is warning his colleagues that the inflation we saw back in 2022 and 2023, that was driven by completely different mechanics.
The stimulus checks and pent-up demand.
Exactly. But the inflation threats of July 2026, these are structural, they're geopolitical. He's essentially saying, look, our old models won't work on this new problem.
So if you are listening to this right now and wondering what a cautious, trapped Fed means for your portfolio, it means uncertainty is the dominant currency today.
It really is.
If they hike in July, consumer credit gets even tighter, mortgage rates stay elevated. It's a tightrope walk over a very deep canyon. But, if the Fed can't control the international supply chain, that means domestic policy levers become even more critical to watch.
Absolutely.
Which brings us to a really fascinating intersection of domestic politics, immigration policy, and banking compliance that's in the briefing today.
This is a wild story.
Yeah, so the Trump administration is pushing for banks to heavily scrutinize lending to immigrants who do not have work authorization.
And this is a perfect example of how political directives force structural nuts and bolts changes in corporate America.
So what does this all mean for the banking sector and consumer credit at large? Walk us through the actual plumbing of this. How does a bank actually implement something like this? Because it's not like a bank teller is just visually inspecting paper documents anymore, right?
Oh, no, not at all. Banking today is entirely built on automated risk assessment APIs.
Right.
When a bank originates a loan, whether that's for a car, a home, or a small business, they run the applicant's data through a highly complex algorithmic risk model. It queries credit bureaus and identity databases in milliseconds.
Just instantly.
Yeah. So if this policy moves forward, banks will have to fundamentally rewrite their legacy compliance software. They're going to need to build or license new mechanisms to verify federal work authorization status in real time before they can extend any credit.
And knowing how notoriously slow legacy banking systems are to update, that sounds incredibly expensive.
It is a massive capital expenditure for their compliance departments. And here is the actual market impact. When compliance costs go up, banks don't just absorb the loss out of the goodness of their hearts.
Obviously not.
They tighten their lending standards across the board to protect their profit margins. They just become more risk-averse in general. So this doesn't just impact immigrants without work authorization. It introduces friction into the broader consumer credit market.
It makes banks slower to lend to everyone.
Exactly.
And credit is the lifeblood of economic expansion. So if you choke the credit, you slow the economy.
Right.
Speaking of domestic friction, there is a whole series of other major political headlines today that are feeding into this overall climate of market uncertainty. I want to run through these real quick.
Go for it.
First, in South Carolina, the governor has appointed Lindsey Graham's sister as the interim senator following his death. Second, on the legal front, a federal judge has ruled that Trump's lawsuit against the IRS was filed for an improper purpose, and they formally referred his lawyer to the bar.
Right.
And third, Trump has announced an upcoming speech where he plans to claim that declassified intelligence reveals 2020 election interference.
Now, if we connect this to the bigger picture, it might initially seem kind of odd to focus on an interim Senate appointment or a bar referral in a financial analysis.
Yeah, I was just going to say, for the everyday investor, those read like standard cable news chyrons. Why does a portfolio manager sitting in Manhattan actually care about an interim Senate seat in South Carolina?
Because at the end of the day, it all comes down to mathematical modeling. Every major corporation and institutional investor relies on discounted cash flow models to figure out what a company is worth today based on what it will earn in the future.
Okay, the standard DCF model.
Right. And the single biggest variable in those models is the corporate tax rate and the general regulatory environment. Every piece of legislation that impacts those variables requires votes in the Senate.
Ah, I see.
So a single interim senator can stall or advance a $1 trillion tax package.
So political volatility literally breaks the math that Wall Street relies on.
That's the exact mechanism. If a chief financial officer doesn't know if the corporate tax rate is going to be 21% or 28% next year, or, if new trade tariffs will be enacted because of election volatility, they do not build the new factory.
They just pause everything.
Yeah. They do not hire the extra 10,000 workers. They delay capital expenditures, and they just hoard cash in 5% money market funds until the smoke clears. The markets have to aggressively price in that corporate paralysis.
But here is where the narrative splits wide open today. While the broader political landscape is creating these massive waves of uncertainty and cash hoarding, there is one sector that is completely ignoring the noise.
Oh, totally ignoring it.
The tech sector is building the infrastructure of tomorrow at a staggering, almost incomprehensible pace. Just look at the briefing. Meta has announced a $50 billion investment in a new data center in Louisiana. 50 billion.
That number is almost difficult to even conceptualize. That is roughly the gross domestic product of a mid-sized country poured into a single U.S. state just for data storage and processing.
Right alongside that headline, we have TSMC, the world's largest contract chip maker, reporting a massive 68% surge in their June revenue.
What's fascinating here is that the market narrative around AI has completely shifted. We are no longer talking about AI as a theoretical software concept, like a chatbot that can write a funny poem.
Right.
We are talking about concrete physical infrastructure.
Yeah, rebar, massive cooling systems, dedicated power substations. When Meta drops $50 billion in Louisiana, they aren't just buying code.
No, they are buying hundreds of acres of land. They are securing massive amounts of energy because these AI data centers require borderline nuclear levels of electrical power to run.
It's insane.
And they are buying hundreds of thousands of physical server racks packed with advanced GPUs to train their next generation models. And that 68% revenue surge for TSMC, that is the ultimate proof of concept.
Actually, break down TSMC's role in this for a second, because I think people often confuse them with the companies that actually design the chips.
That's a good point, yeah. TSMC is a foundry. They do not design chips. They manufacture them for other companies like Apple, NVIDIA, and AMD. They are literally the physical printing press for the digital age.
So if their revenue is up 68% in a single month,
it proves that the global demand for the physical hardware powering AI is completely insatiable. The heavy machinery of the digital economy is being bought up as fast as TSMC can physically fabricate it.
Which brings us to the specific companies fighting for dominance inside those data centers. Our sources note the custom AI chip trade is brutal right now.
Extremely competitive.
On one side, you have the battle between Applied Materials and Amkor Technology, and on the other, it's Broadcom versus Marvell. Let's look at that second matchup first. Broadcom has historically been seen as the reliable builder of networking infrastructure, while Marvell is known for high-growth custom compute chips.
Right.
To me, it sounds like investors are picking vehicles for the AI highway. Broadcom is the reliable, stable SUV, while Marvell is the high-growth, high-risk sports car.
That is a much better way to look at it than just, safe versus risky. You have to look at their actual utility in the supply chain. And if we look at the first matchup, Applied Materials versus Amkor, we see a completely different layer of the ecosystem.
How so?
So Applied Materials makes the unimaginably complex lithography and manufacturing equipment that companies like TSMC use to actually build the chips. They are the picks and shovels of the entire industry.
Got it.
Amkor, on the other hand, specializes in advanced packaging. They take the finished silicon and package it so it can actually connect to a motherboard.
And the market is valuing these companies very differently right now, especially when you factor in the threat of the Fed hiking interest rates like we talked about earlier.
Exactly. Applied Materials is offering incredibly strong, proven profit margins today. Because they sell the essential manufacturing equipment, they have massive pricing power.
Right.
Amkor Technology, meanwhile, is being highlighted for its attractive valuation metrics, meaning its stock price is cheaper relative to its potential future earnings, but it carries a lot more risk.
And in a world where capital might get more expensive in July, investors get impatient. They do not want to wait 5 years for a return.
When interest rates are sitting around 5%, you can't just promise investors that your custom chip architecture will be wildly profitable a decade from now. Institutional capital wants to see cash flow today.
So the toll road like Broadcom or the manufacturing monopoly like Applied Materials becomes much more attractive than a company burning through cash to chase market share.
Precisely.
That transition, from the promise of the future to the profits of today is the perfect bridge to our market surprises today. Because not every visionary growth stock is riding this wave smoothly.
Oh, definitely not.
Case in point is SpaceX. The brief notes their stock sank for the second straight day in private secondary markets, and it is now nearing its $135 initial public offering price.
This is a very telling moment for the aerospace sector, and it really highlights the limits of narrative-driven valuations.
Here's where it gets really interesting, though. With SpaceX sinking, are investors finally demanding clear, near-term growth prospects over the cool factor of space exploration? Is the honeymoon over?
I think it's a collision of both, honestly. When interest rates were near zero, a company like SpaceX could trade almost entirely on the sheer ambition of colonizing Mars.
It was a moonshot, literally.
Literally. It's visionary, and money was virtually free to borrow. But aerospace is perhaps the most capital-intensive industry on Earth. Building starships and launching rockets burns billions of dollars in physical materials, research, and catastrophic failures before you see a single dime of return.
It's the exact opposite of a software company that builds an app once and sells it 1,000,000 times with zero marginal cost.
Precisely. Now that capital is expensive, the market environment has fundamentally shifted its valuation assessment. Investors are looking at SpaceX's balance sheet and asking, how many Starlink subscriptions or commercial satellite launches do you need to execute this quarter just to cover the interest on your corporate debt?
The visionary cool factor doesn't pay the bills in a high-rate environment.
It has abruptly become a show-me-the-money market.
And you can see that relentless show-me-the-money attitude reflected in the final corporate moves of the day. Even though tech and aerospace were the main drivers today, the market is aggressively hunting for yields in places you wouldn't necessarily expect.
Yeah, the active stocks list today is really interesting.
We have Kalshi, the predictive trading platform, launching a pro product aimed at users who want to trade multiple event markets simultaneously. We have OffPoint, a major data management software company, scheduling its Q2 earnings release for August 6th, which analysts are already tearing apart for enterprise growth signals.
Right.
And then, a totally physical brick-and-mortar expansion, Chipotle is announcing the opening of its first restaurant in Mexico.
Now, at first glance, a burrito chain expanding into Mexico might seem completely disconnected from a retail trading platform launching a sophisticated pro tier.
I mean, yeah, they sound like entirely different universes of business.
They are, but they are both reacting to the exact same macroeconomic pressure. The U.S. consumer is squeezed by inflation, and domestic markets in both fast casual dining and retail trading are incredibly saturated. So what does a CEO do to maintain a growth narrative for Wall Street?
You find a new frontier.
Exactly. Kalshi knows that regular retail traders might be trading less because they just have less disposable income right now. But the high-volume professional traders, they are still active.
So Kalshi builds a pro tier, charging subscription fees or higher margins for advanced tools, just extracting more value from their most dedicated user base.
It's a classic software-as-a-service pivot.
And Chipotle is doing the physical version of that. They've built thousands of restaurants in the U.S. To keep the stock price climbing, they have to prove they can export their model internationally. If they can prove the unit economics work in Mexico, suddenly their total addressable market explodes.
It's all about finding untapped capital. Whether you are building predictive trading software, data management systems like OffPoint, or fast food, every management team is desperately trying to engineer new revenue streams to offset the domestic economic drag.
So, bringing this all together, what is the absolute key takeaway for you, the listener, after digesting this massive stack of updates? Today's market is a high-wire balancing act across three completely different arenas.
It really is.
On one side, you have the geopolitical reality, tensions in the Strait of Hormuz threatening to spike global energy costs, reminding us how fragile the physical supply chain really is. In the middle, you have the Federal Reserve walking a tightrope on interest rates, dealing with inflation they can't entirely control while navigating massive domestic political uncertainty.
Right.
And on the other side, you have the undeniable financial gravity of the AI boom, sucking tens of billions of dollars into servers and concrete, entirely decoupled from the noise in Washington.
It is a market being violently pulled in three different directions simultaneously, which leads to a final thought I'd suggest you mull over as you watch your own portfolio this week.
Oh, let's hear it.
We spent a lot of time today talking about how geopolitical tensions, Proposed tolls and shipping blockades in places like the Strait of Hormuz are going to raise the cost of global energy and physical goods
Right. The physical friction of the world economy is increasing.
dramatically. So here is the question for you. If the physical world becomes increasingly expensive, highly regulated, and dangerous to navigate, will that friction actually accelerate the market's obsession with digital AI-driven infrastructure?
Oh, wow.
If you are an institutional investor, do you want to invest in a company that relies on cargo ships navigating a blockaded strait? Or do you want to invest in a company that relies on photons traveling through fiber optic cables in a data center in Louisiana?
Right, where the variables are controlled.
Will we see billions of dollars fundamentally flee the physical supply chain and seek out the digital economy as the ultimate safe haven for capital?
That is an incredibly provocative way to frame it. The messier and more expensive the physical world gets, the more attractive the digital world looks as a sanctuary for investment. That is definitely something to really think deeply about the next time you see a headline about a shipping blockade right next to an earnings report for a semiconductor company.
It puts everything in perspective.
Well, that is all for today's deep dive. Thank you so much for joining us. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage. Take care.